These markets, they be crazy, yo. Super crazy. I don't think that saying is going to be sell in May and go away. I think they're going to change that to melt up May, let's all fly away. At least commodities are doing that and pretty much just about everything else. Holy moly, the markets are crazy. You're watching the Daily Stock Market Brief. This episode is the weekly recap, so we're going to go into some weekly charts. Got a lot to talk about. Timestamps in the description below, where we're going to be breaking down the indices. We're going to be going into also some stock market indicators, commodities, the dollar, bonds, and then wrap it all together with the conclusion. We have some interesting stuff to go over, and I can tell you this. It's some confusing times out there. It's crazy times in the markets, but you already know this. Before we hop into today's episode, I want to go ahead and thank the 384 active patrons. I want to also let you know that if you are part of the Daily Trade Idea tier right over here for only $9 a month, a Starbucks and a little Sammy, I will be posting my trade ideas for the people that are currently active. That will be live most likely tomorrow if I can find some time in the day. It's my wife's birthday. Obviously, I got to focus on her, make her happy. If not tomorrow, then it will be Sunday. And I'm also, yes, I know everyone's asking me about the Discord. I'm looking at Discord. I'm trying to figure it out. Okay, there's a lot of moving pieces right now. So be on the lookout for that. Let's get into today's episode. All right, everybody, welcome back. We're looking at the market dashboard, okay? I got something interesting that I want to point out, okay? As far as when we've been talking on these daily market briefs, as far as, where can we put our money? You want to go into funds or stocks that are in performing sectors. Coco just said hi. And this is 3 months, okay? So we're looking at 3 months percentage change stack ranked, okay? So just notice the top three, okay? See if you catch this. Okay, the top three. Energy, financial, material, that's 3 months. Let's go to 1 month. Material, energy, financial, okay? Right up there in 1 month and 3 month. And then 1 week, energy, materials, financial. The strongest performing sectors have been those three. But did you catch this? Let's go back. Look at the bottom. Technology, down towards the bottom for the 3 month. For the 1 month, technology down towards the bottom. And then the 1 week, technology up a little bit here, but still down on the week. So technology has been this big lagger while energy has really been holding this top spot. And we've been talking about this, so nothing new here. But what I want to show that is a little bit new is, okay, what makes sense here? The jobs report just came out. Okay, this is kind of, this to me is interesting. Like, how do you interpret this? Like, the markets went way up on some horrible job numbers. Perhaps the market is saying, oh, okay, well, the Fed perhaps might not need to worry as much now about tapering as soon as the market perceived. So perhaps yields can just continue to rise and ramp up higher. Perhaps. I'm no genius, but that's one way maybe perhaps that people and the market can interpret that. Because the yields, they sold off, but then they recovered throughout the day. If you were watching like the TNX, for example. And we know that a sharply rising 10-year yield, it had not the greatest effects, which we'll show here, on the technology sector. So I want to bring up relative strength. The top one is energy over SPY. So when it goes up, that means energy performs. When it goes down, that means the SPY outperforms it. And then the one down here is technology over SPY, which means it's a relative strength line of technology. And what am I showing here since 2019? Well, tech has been this great runner, but as soon as yields really started rising, there's been this kind of rotation. And we don't know for sure if this is going to correct itself and roll over lower. And just to remind everybody, just because this goes down does not mean that technology stocks have to go down. It's just from a performance standpoint relative to the SPY, okay? You want to have your money where there's strength. And if technology is underperforming the SPY and we actually crack through, like this was resistance. That's support. We just cracked through it. Are they going to recover? I don't know. But then up here at energy, you can see here we have resistance. We're pushing up. Energy has look how high energy can go just to recoup to where it was in 2019 from a relative standpoint. And we've been calling out energy, and energy's been looking, pretty solid so far. I just wanted to call that out kind of heading into this episode because I've been talking a lot about energy, financial, industrials, and now I want to give you a little bit more deeper dive into what it is that I'm looking at. Pretty interesting stuff. Let's go into the indices. We're going to start off with the S&P 500, and we're going to try to roll through these fairly quickly, okay? First off, weekly time frame. I've been showing this chart, nothing technically broken. All-time record high for the S&P 500, yay! But it's still within this technical rising wedge pattern where we have the VXX down here. I mean, this would look so obvious if we just cracked down through this. Right now, it seems like the market wants to continue this melt-up phase, but we'll see. I mean, I did have a sell signal that was triggered. I'm not going to put too much weight on it, but I'll show you here in the indicator section. Here's the S&P 500 on the daily time frame, rising right around this kind of zone of resistance there. A little bit of a negative divergence. That can change. Price percent oscillator looks like it's trying to cross itself back over to bullish, and we're breaking out of this little sideways consolidation chop. Overall context, still very bullish. Nothing's changed. S&P 500, or the SPY, sorry, on the 30-minute time frame. Look, we called out the possibility yesterday of this maybe being, you know, a little inverse head or whatever, and then potentially taking up to all-time highs. Well, geez, talk about VIX Crush Friday, gap ramp, and it just, you know, catapulted itself to all-time highs. It just chilled there for the rest of the day after the first hour or so of trading, like crazy stuff. Negative divergence. This could be a potential flagging consolidation, you know, whatever, big pull consolidation. Perhaps we're gearing up for just another continuation of this melt up. It's to be seen. I don't know. Just look how crazy this market is. Just the price action's bonkers, you know. You know what's crazy is, okay, let's break this down. Right around this day, right, this crackdown through here and this sell-off, wasn't that right when Yellen was basically saying something about we can raise rates, and then she backtracked it somewhere, I forget where, and then the market recovered like super quick and then skyrocketed up higher. I don't know. Perhaps the market is just married to what not the Fed says, but that was the Treasury, which was weird, by the way, for the Treasury even, you know, to talk about that. Why even talk about that? It doesn't make much sense. Dow Jones, weekly time frame, still within this technical rising wedge. Really, honestly, I don't know if you want to call it a rising wedge or not. I grabbed support from this area that could potentially act as resistance, and I'm following this trend line. All-time record closing high on the week, up 2.67%. 902 points. What the heck? Absolutely bonkers. But that's not the only thing that's bonkers. No. Transports. Holy moly. Above the weekly Bollinger Band, the RSI printed 83.86. If you don't follow me on Twitter, I actually showed this. I'll go over it now. But just look at this. Week after week, the transports are rising and rising, which is crazy to me because we've been seeing oil, you know, get stronger and stronger too. And, you know, if oil continues to rise, oil is one of the biggest expenses for the transports. So I don't know what's going on here. You know, craziness. Let's look at the weekly time frame for the transports, but a lot longer time frame, dating back to 1922, even earlier. The only reason I'm doing this is because I was like, okay, how the RSI is such a high print. When is the last times in history it's done this? It's been over 20 years. 1997 was the last time we hit a high point from there, and you know what happened. That was right around the dot-com burst, the bubble, but it took, you know, a while to get through it, and then we rolled itself over, which it doesn't look that big there. Even in the 70s, right? Early 70s here, we hit that, rolled itself over, and you can see here, tap, and it was just a lot of sideways chop, just up and down and everywhere right around there. Here was 1929, you know, that reached a really high level and that rolled itself over. And then right over here, what I'm noticing here, first off, it's a very high print like it was on all these times, and it never resulted in anything good. That doesn't mean anything bad's going to happen, but what I've seen here on these charts is, wow, even though it got those high of readings, a lot of the times the market continued to press higher, and then something happened later down the road shortly thereafter. So I don't know. We'll continue to watch it. To me, this doesn't look like the best place to go long. I don't know why you would or why you'd want to, but you know, it is what it is. It's the new world we live in. The Dow Jones on the daily time frame, just breaking through this little area of resistance right up here. It looks like it wants to press through this area of consolidation and continue to move higher. To be honest, I think it was a few episodes ago or something, right around we were at this 20-day moving average. I was kind of thinking that the Dow Jones out of all of them look probably the most strongest. And we're starting to see kind of that strength come in here. You see the price percent oscillator trying to cross up here. Can it be reversed? Yeah, but from a daily perspective, everything's in full bullish mode. And from a price action perspective, there are no red flags really right here. at all. I mean, you have, negative divergence on the RSI, negative divergence on the price percent oscillator, but those, it's building. It's not confirmed by any means. Now, 30-minute time frame for the DIA. Talk about just nutty price action here. So this was all that volume, this chop back and forth. That could be potentially an area of support. As soon as we got through that, just melt up mayhem right here. You can see we came up, we consolidated, bursted through that, and then we kind of formed somewhat of a ascending triangle here, and we ramped up higher. And just look at the RSI here, just super overbought too as well. Just bonkers price action, crazy environment. Interesting stuff though, to say the least. Let's look at the NASDAQ. Now this is kind of the tech stocks. They make up a big portion. So if tech goes, it hurts the NASDAQ 100, and it could also hurt the S&P 500, especially if they don't start performing. So I wanted to just re-put up the XLK over SPY right here, so you can kind of see once again how technology has been underperforming the SPY here. And from a weekly perspective, I mean, nothing's really too bad. I mean, we pulled back, little hammer candle into the 20-day moving average. So I mean, nothing's technically really broken here either. Yeah, it's been struggling, and I think it could potentially struggle more if we start seeing like the 10-year flag out, or if it is flagging but breaking out very aggressively. Perhaps then we see a little bit more weakness in some big tech stocks as people continue to rotate into more economically sensitive areas. And also, which we'll get into that actually a little bit later. Let's look at the cues on the 30-minute time frame. On yesterday's video, we talked about potentially strength coming back in and seeing a bounce into tech. And I made the case for that as to why, and we saw some of that strength today. So if you were hedging long, it made some good sense. And we filled that gap that was above us, so that was an area of resistance, and then we sold off kind of throughout that day, and we created a new gap below us. This could be potentially a little flagging, falling wedge pattern here to potentially go higher. So we'll continue to see how that develops. Just note that there's still a lot of resistance up ahead on the 30-minute time frame. So we'll see that. Continue to watch it. The semiconductors, the SOXX, I wanted to show this as well from a weekly perspective. Look at last time we pulled into the 20 EMA on the weekly perspective, we bounced and we created all-time highs. Okay, I mean, we tagged it multiple times for multiple weeks, but it's been holding pretty good. And I just wanted to call that out, that it is still holding. It was looking very bearish on the week, down significantly. Okay, now from the daily perspective, we called out that area of support and we saw some strength come in. It finished positive on the week, not by much, basically flat, 0.06%. Interesting stuff. Russell 2000. Now, this is getting interesting here, because this is a toughie. If it's true, if the market perceives it as, with these weak job numbers, the Fed can presume it's crazy, printing and nothing to worry about as far as having to, taper, then perhaps we continue seeing what we've been seeing the market do with yields, and you can see the 10-year rise. And if the 10-year rise, that's good for financials, and 20% of the holdings on the IWM here is financials, one of the biggest holdings. So if that's the case, well, what if this is just a pennant kind of forming here, a little symmetrical triangle, and all of a sudden out of nowhere, because financials start to even blast up even higher, the markets continue to ramp, we see the IWM, the Russell 2000, really start moving. It's a possibility, and I got to keep that as a possibility. But still, overall, this looks like a crazy period of distribution. The 13 EMA is still holding. Negative divergence on the RSI, and we still have the price percent oscillator pretty bearish, pointing downwards. Momentum's kind of slowing, so it does suggest potentially breaking down through this trend or some more sideways consolidation. So we'll continue to watch that. The daily time frame tells a little bit different of a story. This could be a complex head and shoulder pattern. You can see shoulder, 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 head, shoulder, 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 and then this neckline here. However, anything could happen. We're back above the 20-day. We're back above the 50. This could be consolidation, and we could rip higher. Would I be shocked to see that? No, I wouldn't. I'm not shocked to see anything anymore, at least. IWM on the 30-minute time frame. Pennant pattern. Watching this. Pull. This could also be the early stage. Now, we got to see how futures do Sunday overall, but this could just calling out potential pennant, and that could take us right back up to 230.50. Very simple. We've seen it here, when it came down, we ramped right up. So it's still in the cards. But remember, I was talking about financials. They are an important measure And when I look at financials, I want to just throw the 30-minute time frame here of the BKX. And first off, it follows technical patterns quite well. You can see a little diamond pattern. It broke down, kind of started getting up, falling wedge, broke out. A little flagging channel pattern here, broke out. Another channel, broke out. And now, this could very well be a rising wedge. And you can see the negative divergence there on the RSI. It has to be confirmed, obviously, but just note that, the financials have been doing exceptionally well. They're moving like crazy. And there's a strong possibility that it could take like a little bit of a breather eventually. So that's also, something to keep in the back of your noggin. NYSE, the only NYSE chart that I want to show here. First off, all-time record highs, so continue to press higher and higher. Melt up May, let's fly away. 2.29% up. It's somewhat coming into this previous support, which then could become resistance, but it still says that we have room to go higher. And if this trend line, this blue trend line right here, talk about just the most steepest trend of support I've ever seen in pretty much any chart other than, well, I guess every single commodity, but it's something to watch. If it starts breaking through those trends, then perhaps we get some sort of correction, and then we continue to ramp up higher to all-time highs. I'll talk more about the conclusion section on what I actually think will probably happen. But let's get into some stock market indicators. The first one is the sell signal. Sell signal activated. Cross the red line at 0.8. We are currently at the 0.804, so we did just cross over. So it does say, okay, be careful here. But from a technical perspective, an absolute perspective, when I look at the charts, they look like they're just about to break out. So if this is, a bull trap, that would be some sick stuff, because everything looks like extremely bullish right now. So I'm not going to put too much weight on it, but I'm not going to forget that this is very active right here. Just so you know, it's not like, oh, sell signal, I'm going to go buy puts. Not quite there yet. The VIX crushed Friday to the fullest extent, down 9.24%, back down here at an area at 6.69, which is right around this area of support. Now, we talked about this as being an area to potentially take profits. We closed this gap. That's why I made it white. We came back up, headed lower, kind of closed this gap, but not fully yet. We started to work on it. So this still remains a potential risk to fill. Now, if that's the case, and we had that sell signal that's triggered, and we come all the way back down here to 16, and we've been there before when we saw spikes. Just keep in mind that it's a good time to make sure that you do have stop losses and take some profits if you're scalping or whatever the case may be. Reduce some scales, whatever the case may be, and go from there, and then see what takes place. We have immediate risk up here as far as these two open gaps, and that's kind of where I'd be like, okay, I'd be willing to put a little bit more money into play from a long perspective, because if we get a big spike up there, that can act as an area of resistance, which means the S&P 500 or various stocks can be finding some support. Now, from a divergent standpoint, the S&P 500% of stocks above the 200-day moving average, you can see the S&P 500 continues to ramp higher, but we still currently have a divergence here, which means the market's going higher, but yet the underlying breadth here is kind of dying. However, it is still at a very high print, so take it for what you want. Same thing going on with the 50-day moving average, percent of stocks above the S&P 500. S&P 500 is higher, percent of stocks above the 50-day. Currently diverged, but we have a little bit of a spike up here, which this could be taken out very quickly and very aggressively, especially if we keep continuing to move higher. And we're really going to need tech to play in that game, especially from what we've seen in the previous video where I showed just how important they actually are because of the holdings that the SPY. It's a big portion of the SPY. It's I believe technology makes up for around 24%, so a big portion. Now let's look at the NASDAQ percent of stocks above the 50-day moving average. We had divergence back here. We had a divergence here currently, and then it actually played out. So we'll see here what the NASDAQ wants to do here shortly. Now, there we go. BPNDX. This is one of the reasons that kind of led to me believing that we can see a bounce in tech, and also even like the ARK fund, which we saw that bounce and then it came back up, hit that resistance, and then got rejected. So we'll see what plays out, but one of them was because the signal chart was oversold, which made sense to me, and then on top of that we saw some stuff moving into areas of support. So when you stack these kind of ideals in your favor, it does make sense from a technical perspective and from a risk versus reward standpoint to be able to confidently go into various stocks or indices From a sentiment perspective, not much going on with the asset managers other than just a little dip here. We were above 100, now we're back below. So we were max long leverage, took a little bit of a breather. You can see here, Ridex also popped up just a little bit, but nothing crazy. It still says, hey, I'm a full bull right here. So we'll just see if there's any crazy developments that take place with that, but nothing stands out to me, to be honest. Commodities. This is where it gets interesting. Now, tomorrow or Sunday, I have a gold video where I go in a little bit more depth in gold. It's a sponsored video, but I talk about the sponsor at the end, and I talk about all my stuff that I look at the beginning portions of the video. And it is some pretty cool stuff that I found from Tom McClellan that I'm pretty excited to share. Now, this is getting a little interesting to me. Okay, a lot of people might be looking at this right here as a perfect opportunity to short gold as it's moving into that 50-day moving average, into the 38.2 retracement level, and the possibility that the 10-year will continue to rise. Now, as we stated in other videos, the 10-year can rise and gold can rise too. What we've seen recently, though, is as the 10-year went up, it actually bottomed in August, the 10-year, and then it started going way up as gold started moving down, so they had a negative correlation. However, if inflation outpaces the 10-year, so you look at the real yield versus the nominal, you can have them go up together, which is very possible. And I do think that we're going to have higher inflation. So I don't know if right now it's going to be taking a little bit of breather, then potentially head higher when we do have inflation. But just know we are breaking out of this channel. So it looks good right now. Price percent oscillator crossed over, but it is still below zero. So this looks good, but I just don't feel convinced with this move yet. But I'm going to be keeping an eye on it. And like I said, I am going to be getting into some positions here in some various miners, potentially longer term, perhaps some long-term option plays there that are dated into 2023 because they're available now. Here's silver. Silver broke out of that falling wedge. Boom, we're coming up into that area of resistance above the 50, above the 20-day, above the 50-day. Price percent oscillator looks like wants to cross over. We got to get above this resistance. Now, why is all of this stuff, moving up higher? Well, it could be because the dollar was falling, which we'll be getting into. Let's first look at some other commodities. Oil looks like it's trying to break out of this range right here. If it does, oh man, I don't think that it's going to have an issue in the slightest to ramp up to 75, without a doubt. Now, it needs to get a confirmed weekly close above this resistance. It did not. So above 67.50, 68, right around there, it's not there yet. Price percent oscillator is kind of, dying some steam right here. And then the RSI, obviously, it's actually pretty bullish here still. So we'll see. We will see. If it does break out, that can be very good for energy and the relative strength of energy, which we showed at the beginning of this episode. CRB, Commodities Index. Holy crud. This thing is flying. Look at this thing move. It broke through the 205 and it's trying to take out this with ease. It's cutting like through butter. This whole, it's insane. And then you look at all the other stuff. Look at lumber. What the heck? This is, geez, you got to really think so it's crazy to me just how euphoric everything is. Now, you don't get everyday retail traders hop in the lumber's futures market. It's a whole different breed, but you can see this euphoria pouring out into multiple different assets. And, everyone's a stock market participant, right? Which is fine. And it's a good thing to see more people come in. That's not what I'm trying to say. But what I am trying to say is a lot of the market participants are throwing complete caution into the wind and trying to get 4,000, 5,000% gainers without taking profits, which is awesome if they get it. But it's also, that is a sentiment check. Like where are we? People used to say, oh yeah, you can save and slowly invest and you can get 8% a year. Why? When you can apparently get 1,000% a month. Crazy. Corn, vertical. Wheat, vertical. Soybeans, vertical. Copper, vertical. Insane. Dollar, getting destroyed from the weekly perspective. I don't think that this is an inverse head and shoulder anymore. I think that week cracked it. Can it change? It can. But, let's lose our purchasing power while everything gets more expensive and pretend like we, have, more value. It's crazy to me. I know we're going to be going into the stock market. The grocery stores and seeing more expensive food as time progresses. Corn, where's corn again? Corn, I don't think many people understand just how many products, have corn in them. Not even just food products, but there's also like consumer products that are utilized in corn. And that's crazy. It's crazy. It's kind of actually scary. You make more money in the stock market, but then you go spend more everywhere else. It's, hey, what is going on here? Exciting times, though, I will say. U.S. dollar on the daily time frame, that was a big down day. We are still positive on the year, okay? What does that mean? Well, to me, that means we're just basing. This is just sideways consolidation. It's not bearish to me. I mean, the overall context of the chart is bearish, but as far as if you're looking from, hey, you're just looking at a percentage point on a screen from the yearly perspective, the dollar's up, okay? That could change quickly. And as you see, the move down here in the dollar really fueled a lot of different assets, right? S&P 500 moved up. We're seeing digital currencies, cryptos moving up. We're seeing other various like gold, right? Silver up. We're seeing other commodities go up. So, as the dollar continues to weaken, I mean, it's a world that we're living in where savers are absolute complete losers, which really sucks, if you are a saver, because, you save money and you constantly lose value holding cash because of rising prices all around you. It's like I always talk about the housing market, people that saved up to buy their house, right? They're saving, and then all of a sudden lumber goes vertical, and then, say they save $24,000, $25,000 up for a down payment on a house. Well, the rising cost of lumber completely obliterated their down payment. By the way, the average cost of a home is up around $24,000 just because of the lumber. Let's look at bonds and yields, okay? Quickly go over this. 10-year flagging currently. Now, it was down on the day-to-day, and it quickly recovered. This to me says, okay, I mean, this is still a flag pattern. We need to get confirmation. But if we start breaking out of there, I mean, what's to stop this thing from continuing to press up higher? What's to stop the market from continuing to press it up higher? Meanwhile, the Fed is not thinking about raising rates. And now with the weak jobs number, perhaps that makes them say, they're not going to change course. I guess we don't know. If we start seeing a breakout of this, I think we're going to see continued weakness. Depends on the move itself, but if we do get a breakout, we could very well see continued weakness in gold, which is a strong possibility, unless if obviously the inflation rate outpaces it, the real yield versus the nominal yield. And we could also potentially see tech also suffer a little bit. However, what does good when the yields continue to rise? Financials do typically pretty good. Now look at technology, right? So this is the 10-year up here. We have tech, relative strength to SPY, and then we have financials relative to SPY. So you can see here, as the 30-year, I put the 30-year on the chart. I should have put the 10-year. Why did I do that? It is what it is, but they look pretty similar, so you can get a good idea. You can see as the rates were rising, the rate was rising. XLK, you can see it was kind of from relative standpoint, it was still rising, but it was weakening. You can see it curving down. Whereas the financials, you can see, were down, and then they started to recover as the market starts to press higher and higher. Banks, they borrow short term, they lend long term. When yields rise, 10 to 30 year, and they're lending long term, I mean, the higher the yield, they make more margin. It's pretty simple. So if we do continue to see rates break out, I would expect financials to do pretty well. And what's interesting to me is even during this period of consolidation here on the 30-year or even on the 10-year right here, financials held up quite well. And some banks really started taking off. So perhaps they take a little breather here soon and then continue the momentum. I don't know yet, but it looks like it's setting up. If we do get a breakout of a bull flag, we can continue to see stuff like energy perform. We can see stuff like financials and continuing potentially even the material sector, and as well as commodities, especially if the dollar keeps falling. So we'll continue to monitor it. We'll continue to see it. Be careful out there. Just to wrap up, overall thoughts, conclusion. First off, we are obviously in a very, very bull market. However, there comes a lot of stipulation with this because these charts we haven't seen overextended levels like this for over 20 years, an RSI reading like this on a weekly time frame for the transports. But yet we're seeing things like oil continue to rise too, about to break out of this resistance area. And if it continues to press higher, I mean, that will eventually put pressure on transports, right? So we have a lot of moving pieces right now. So the best thing to do is be, one, very diligent with managing your risk. Because prices are moving all over the place and we're starting to see stocks, obviously move, 10, 20% in a single day is becoming the normal. Something to consider is you don't need to risk an entire portfolio or a huge position on individual names. You can reduce position sizing and just, because of how volatile and how fast things move, you can make a pretty good percentage point on even with, with less cash on hand. Because remember, a portfolio, if you have $100,000, okay, and you're investing in all these various different things, if you're having, for example, 50% of that is cash. This is just a rough example. But then the market, all your stocks go down 50%. You didn't lose 50% of your portfolio. You only lost half or 25% of your portfolio, if that makes sense. So having cash positions for something bad to take place is never a bad idea. Just know that we're living in a time where the markets and everything is really forcing risk-on environment. It's forcing spending, credit, because if you save your money in cash, you just apparently, your money's getting devalued. Perhaps that might change in the future. It's hard to say, but as of now, the market is full bull mode. See you later.